So let's bring in Bob Iaccino. We've got the founder, we've got the chief strategist of Path Trading Partners with us this Wednesday. Bob, Happy New Year. So far this morning, we've been talking about the move lower to begin the week in stocks. I'm wondering how much of that can we chalk up to the spike we saw in the dollar back to 102. It seems recently the two have shared a pretty well-defined inverse correlation.
Yeah, I think that's definitely some of it, Ben. When you look at the dollar to me is interesting because you're talking about a situation where rates have actually been going higher for the first 2 days of the year. That's just yesterday and today, not that big a deal. But when you look at the 10-year note, for example, it finished the year unchanged.
Yeah,
Literally
around
unchanged.
3.8.
Started at 388.
Right.
Ended at 388.
Yeah.
And I don't think anyone would have thought that
But
given the
now inching back
volatility
up
that
to
we had.
4%, you're saying?
Well, I'm not necessarily saying we're going there, but when
Yeah.
you look at it, the year-over-year change right now, the 10-year is positive. And from that perspective, what actually happened with sort of the medium-term tightness or easiness based on the Treasury curve, and it's basically unchanged. So we're looking at an equity market that is basically priced in 6 rate cuts, right? And when you start to look at the data and you start to look at the possibility that we might be going into a reflationary scenario, and I'm not talking necessarily about inflation alone, I'm talking about stocks, I'm talking about risk assets. Pending home sales is trending higher now, off of a very low level, but it's still trending higher. And interest rates, 30-year mortgages, et cetera, are not that much different than where they were at the beginning of 2022. So when you look at it from that perspective, what are we actually moving into? It's probably a decent idea that those 6 rate cuts aren't going to happen.
Bob, let's talk a little bit about that dollar indices relationship. And I think it's important to put it into perspective, right? Because it has, on the bigger picture, broken down in many ways when you look at the strength we've seen in stocks versus the dollar, which has been very much range bound. And along those lines of putting it into perspective, just taking a look at the NASDAQ, because this is one of the majors that stood out and kind of ties into your point about the 10-year inching its way up. I think tech, you're going to see that impact here as the NASDAQ from recent highs, 17,165 down to, again, 16,600 or just below it. But I want to point out here now, changing apples to oranges in some ways. Here's a look at the S&Ps. This helps us kind of put that selling we saw yesterday into perspective. And this chart as well, I mean, as you look at the quad here, you've got yesterday it was just the Dow recently into a new all-time high before that selling that we saw. But Bob, today the number, the JOLTs will get, I'm wondering, is it going to be overshadowed by the FOMC minutes later this afternoon and then maybe even more so non-farm payrolls Friday?
Yeah, the JOLTs is really, for lack of a better word, a janky set of numbers, right? Because there's been suspicions that jobs have been reported just to try and get extra applicants to jobs that needed. There's just the numbers are kind of screwy. Yeah. It's really kind of like a lesser level number because of its source feed, which is just survey data. But from that perspective, it was watched a lot at the middle of last year. Yeah. And we had a big drop in those JOLTs jobs openings last week. Again, last read, I should say. And again, talking about us potentially entering a reflationary scenario. Are they dropping because the jobs are getting filled, or are they dropping because the jobs aren't available? They don't exist anymore. And I suspect it's the former, not the latter. I suspect the jobs are getting filled because when you look at the employment figures, we're still sub 4% on the unemployment rate, and we're still not seeing a recessionary or even an economic slowing showing up in the non-farm payrolls reports or in the weekly jobless claims. Right. So when you look at it from that perspective, again, I think we're more entering a no landing period as opposed to a soft landing, because I think the economy is heating up, and I think inflation, while only the PCE core has a 2 handle on it, everything else has a 3 or a 4 handle on it. You're still looking at a situation where the Fed may need to fight inflation. That's what I mean about the dollar. When you're looking at economic weakness, it definitely is leading in the EU and the UK and others. Maybe not Japan this time. But it's definitely leading in those 2 major economies that the dollar trades against. And if we're going to start pricing out those 6 rate cuts and maybe bring it to a more realistic 3 rate cut level in the market, that means the dollar higher and possibly, based on the inversion you talked about, equities a little bit lower.
And if we see those trends continue in Europe, right, even to begin the week, it was UK, I think, with weaker than expected food prices, as far as I remember yesterday. So maybe that will continue. Bob, one of the things we've discussed quite a bit here on the show is that difficult period to get from 3% to 2%, right? The Fed's still leaning on the lag here right now with some work to be done yet. I guess I'm kind of looking at this lean on the lag versus more work to be done as kind of opposite ends of the spectrum. How much more clarity we're going to get today from the Fed minutes, because kind of a contentious environment headed into this one. You had Powell, who was very dovish, yet recently we've heard a bit more of a hawkish tone from some of the individual Fed speakers.
Yeah, and I think that's really appropriate. I think you're a runner, right, Ben? I know Jenny is. I think you're a runner. That last 2 miles, 3 miles
Oh, it's
of those
brutal.
marathons, yeah, are really, really a struggle. Might even be the
That's
last
when you're
10
most
miles
often a
for all I know.
walker, not a runner,
Yeah.
actually, Bob.
I mean, you can't get me to run more than a mile and a half because I just need to get back to the bench press after that. But from that perspective, when you're looking at that, you can relate it to bench press as well. Those last couple of reps, those last 5 to 10 miles in a marathon are the hardest ones. And there's no reason to think that this last 1 to 1.5%, depending on what reading you're looking at, of inflation is going to be easy, especially since they may have actually achieved that elusive soft landing in terms of not crushing the economy into a recession, but 2% inflation had not been reached yet. So when we've got jobs strong, we've got consumer spending, we've got wages still running at about a 4.8% clip. That's an increase of 4.8%. And you still see consumer spending. The one caveat I would throw in, which I talked about a little bit with you last year, was if the Christmas season was strong, which it seems like it may have been, if the holiday season spending was strong, that may bring a little bit of a hangover to consumers over the first couple of months of the year as they get their credit card bills and as their buy now, pay laters start to come due, which again, that's interest free. But when you look at it from that perspective, maybe they slow down a little bit, but we're seeing pending home sales trending up, and we're seeing mortgage rates head a little bit lower. So maybe the housing market is the next trigger for what could drive that sort of durable goods and possibly some goods inflation that we haven't seen.
Bob, we've got comments from Barkin coming across the wire here as we speak, talking about how there's potential for further rate hikes to come. He's saying that there's a case for he sees a case for a soft landing, but inevitably, ultimately, not necessarily certainty at this point, it looks like, but a soft landing inevitable. Talk to us a little bit about some of the other foreign currencies. We shift our attention away from the Fed here a little bit more globally. Where is your attention? The Bank of England, the ECB, the BOJ, because all of these seem to be very closely watching. All of these are going to influence the dollar one way or the other also.
It's the BOJ.
Okay.
I mean, there's no doubt about it. Watching the BOJ, that was one of my potential surprises of 2024 when I wrote a piece on that, was that basically I thought the BOJ may actually hike rates. And that would be kind of shocking to the world. They may actually remove that ban completely on the 10-year because they've got inflation and it is stable and it is growing and their economy is actually on an upward trajectory for the first time in, I don't know, 4,000 years, it seems like. So I think the BOJ is definitely one that might shock the globe because you know it as well as anybody, Ben. The carry trade with the yen will get affected by that, and that could cause a lot of chaos in the currency markets if they were to actually do it. I think it's only about a 10, maybe a 20% probability, but if it happens, it's the currency shock that people wouldn't necessarily be expecting.
All right, appreciate it, Bob. A solid look here, talking financial markets with the founder, the chief strategist of Path Trading Partners, Bob Iaccino.